Hello, everybody, and welcome to Back to Basics, the cash flow part 2. You remember from part 1 how I described that the profit at the bottom of the P&L account rarely, if ever, agrees to the movement in the bank account. And that's for two principal reasons. Firstly, the timing of transactions, and secondly, the nature of transactions, i.e., are they revenue or capital? Let's remind ourselves of our little baked bean company profit and loss account. And from now on, I'd like to change the title of the net profit before tax to operating profit. I will be doing an extended version of the profit and loss account in future episodes. And you'll see there are different descriptions of the profit in there. One is the operating profit. And in preparing a cash flow statement, it's the operating profit that we go down to. In my example of the baked bean company, actually that net profit before tax is the operating profit. Now let's remind ourselves of the balance sheet that we had for Baked Bean Co. And I've popped in there again the movement on the bank account of £520,000, the profit and loss account movement of £750,000, and therefore this missing £230,000. Where is it? That's the whole purpose of preparing a cash flow statement. Now, you'll also remember from an earlier episode on the balance sheet how I described that all assets and liabilities, when added together, equal nil. All debits equal credits. That's why it's called the balance sheet. However, we don't present assets and liabilities in that long, meaningless row. We actually present them in a way that allows the reader to understand the performance of the business. We present them according to how they behave. By example, if we take the current assets here and compare them to the current liabilities, we get the net current assets. And that tells us about the liquidity of the company and allows us to produce some key performance indicator results, such as the current ratio or the quick ratio. Stage 1, however, in preparing a cash flow statement is indeed to put the assets and liabilities in one long row. And I've done that here. Now, as you can see, they all add up to, both sides add up to zero, the current and the prior year. What I'm going to do now is to introduce a movement column. And I've put in there once again the movement on the bank account and the profit and loss account to show our missing £230,000. Now, arithmetically, you can see that the current year balance sheet equals nil at the bottom, as does the prior. Therefore, if we were to populate the remaining rows in the movement column, i.e. our missing £230,000, that will also equal zero. Let's do that now. So we're now into the second stage of preparing a cash flow statement. We need to allocate the movement column into those items that relate to operating profit and those that relate to the balance sheet. Here's the template that we carry out those calculations on. I'm just going to move myself across there. Okay, and the first thing that I'd like us to do, the first row that I want us to allocate actually is the profit and loss account. By reminder, here is our operating profit. £1 million, corporation tax of £250,000, and the bottom line movement of £750,000. So million, 250 and 750. Let's allocate that now. Here's our profit and loss account movement of £750,000. I'm going to put the £1 million straight into the operating profit column, and the 250 goes into the corporation tax column. Let's go back up to the top now and allocate the rest of those columns. First of all, fixed assets. Fixed assets move for two reasons, principally two reasons. One is because you're buying new fixed assets or you're disposing of them. And two is that you've got depreciation on those assets. In the background, I've got a fixed asset register for this baked bean company. You'll remember from Cashflow Part 1 how we bought a canning machine for £100,000. So we allocate, first of all, that capital transaction into the capital expenditure column there of £100,000. Put our £50,000 depreciation as a timing issue into the operating profit column. And we do the same with the remainder of fixtures and fittings and computer equipment. Now let's deal with the current assets and the current liability movements. We've got timing issues and they relate to the operating profit. This is when we pay for items compared to when they appear in the profit and loss account. So here we've got an increase in stock of £30,000 and we've got a decrease in debtors of £40,000. They're timing issues that relate to the operating profit column. We've also got £25,000 increase in trade creditors, a timing issue. Again, it's in the operating profit column. Corporation tax is allocated onto the balance sheet because remember, we only go down to operating profit level. Everything below that is considered to be a balance sheet item for analysis. And therefore it goes its own column there of £70,000. Other items we've got to allocate, we've got a movement of £300,000 on our long-term loans. We've got repayments and therefore going to their own column there. It's a capital transaction. So we've now got effectively our cash flow statement prepared, but it's not in the most meaningful format. So we present it in a report format. And all we're effectively doing is taking these totals at the bottom. We could understand the cash flow from here by saying, well, where did the money go? Well, we had 1.1 million in cash-based operating profit. We paid corporation tax of 180,000. We repaid loans of 300,000 pounds, and we spent 100,000 pounds on capital expenditure. But let's put it in the report format that we're all used to. Okay, so again, starting at the top, we've got our operating profit of £1 million. Adding on our non-cash items in the profit and loss account, which is the depreciation, of £65,000. We now adjust for our working capital for costs and income tied up there, and we've got £35,000 in total in that column. By reminder, I'm taking them off the bottom of these columns here in my cash flow template. So we can now see our cash-based profit of £1.1 million. So that ignores all of the non-cash items and the timing of expenditure in the profit and loss account. So what happened on the balance sheet? So we spent money on the balance sheet. We bought £100,000 for our canning machine. We repaid loans of £300,000. And last year's corporation tax bill, we paid of £180,000. And that comes, by reminder, from this column here. It's a combination of the figure on the profit and loss account of £250,000 and the accrual movement. So let's summarise our cash flow statement. We had a £1 million operating profit, but we had a movement in the bank of £520,000. What happened? First of all, we had non-cash items in the form of depreciation, £65,000. We had movements in our working capital of £35,000. Therefore, ignoring the timing of transactions and non-cash items in the profit and loss account, we would have had a profit of 1.1 million if the profit and loss account reflected the transactions that were in the bank. So what happened on the balance sheet in terms of capital transactions? We spent £100,000 on our new canning machine. We had loan repayments of £300,000. And we paid last year's corporation tax bill of £180,000. So total transactions capital transactions on the balance sheet of £580,000. That gives us our movement in cash of £520,000. So to reconcile that, if we add on to our movement, the opening balance on the bank account of £115,000, we must therefore have a closing cash balance of £635,000. And indeed, if you check the balance sheet, you'll see that reconciles to £635,000. If anybody would like a copy of the cash flow template that I've used in this presentation, then please email me. I'd be very happy to send one to you. I'll see you in the next episode of Back to Basics.